Well, good morning, and thank you for joining us today. Of course, money means different things to different people, and today we're hoping to present a framework for you to make smart financial decisions in today's webinar, Successful Retirement Choices. Today we're going to cover a number of topics. We're going to cover the United Airlines retiree options and benefits. Does the lump sum option always make sense? Retiree medical options and selection. Where the VIBA fits into your plan. Deciphering the new PRAP. Disbursement strategies, how to draw down assets in retirement. Key concerns of pilots that are based on interviews and surveys conducted by Efficient Wealth Management. And finally, a wealth management process that works. Two of the focus areas of today's webinar, though, will really be deciphering the new PRAP and talking a little bit about the retiree medical options and selection, because we get a lot of questions about that. Our promise today to you is to help you make a clear-cut, to provide for you, a clear-cut process for making informed decisions about your money. We're going to present a fee-free, risk-free model that you can emulate without me, without an advisor, and the question is, why would we do such a thing? Simply put, we're a fiduciary firm. Not everyone who sits in on these meetings is a good fit for our firm as a boutique wealth management firm. We really restrict our clientele to those people we can make a meaningful impact for. So we want to have something for everyone, regardless of whether or not they're clients today. As I said, we're not right for everyone, but do stay tuned, because at the end of this webinar, we'll have a special offer for those who make it through to the end, and some freebies there. So I always like to start these things with a little introduction to myself for those people who don't know me. My name, of course, is Paul Carroll. I am the CEO and founder of Efficient Wealth Management. I came to this country in the fall of 1979 with $200 and a toothbrush. I was 17 years old. I came on a bright orange Braniff jumbo jet, and I had no idea what I was doing. But before long, I landed on my feet, found myself in the Air Force, working my way through the University of Maryland towards my bachelor's degree in business. About the same time that I finished my tour of duty in the military, which I believe was quite a success, I also graduated from the University of Maryland, summa cum laude. And that's great, fine and dandy. I'm still a stranger in a strange land, didn't know what to do next, so I decided I'd go to graduate school. Texas A&M University offered me a very attractive package to attend their graduate finance program, and that was a great deal for me because, frankly, since I was quite young, I'd always wanted to get into the financial industry. I always wanted to do something to help people with their finances. So this was sort of a dream come true, even if it was a little bit of a circuitous route with the Air Force and such. I got through the University of Texas A&M University, graduated with a master's in finance, got myself a job at Smith Barney. Now, we all know Smith Barney. We make money the old-fashioned way. We steal it. No, I probably need to stop telling that story, but the reality is at Smith Barney, they sent me to New York, put me through their program, and I got my Series 7 with a state high at the time and a relatively rare 95 on the first attempt. I don't know if you've ever seen the movie In Pursuit of Happiness with Will Smith, but in that movie it shows Will Smith, he was a homeless guy of all people, going out, getting himself a job at broker, going to the New York Training Academy, and it was almost exactly the same environment, 4-month program. Though it does tell you something else about the brokerage industry, and that is they really don't care what your financial background is. They're looking for certain sales skills. And as we saw in the movie, a homeless man with the right sales skills could be taught how to be a stockbroker. Well, I got my Series 7, the state high score. I had my master's in finance, had all this other background and experience. And so Smith Barney decided to use my experience to the best of their and my ability. They gave me a black phone, a phone book, a product sheet of stuff to sell, and they call that dialing for dollars. Well, that wasn't exactly what I had in mind. That's not what I consider to be a profession. I was very disillusioned. I was somewhat, for want of a good mentor, I decided I was going to go do something else with my life. I decided to go learn how to fly jets. Well, after a few, obviously this sounded great. I was a young man. It was an easy thing to do. There was a shortage of pilots at the time, which of course there never really is. Something like 7 jobs later, I did land on my feet at Continental Airlines, and I was a captain on the 737 when 9/11 struck. As we know, that 9/11, it was a bad day for America. It was a terrible day for the airlines, and it wasn't long after that that I received a furlough letter from Continental. And that was a great thing because that letter changed my life. I did a lot of soul searching and decided that I'd had enough of this. I'd had enough of going from job to job to job and never getting any kind of seniority, watching, unfortunately I didn't see it coming at the time, but watching not only 9/11 decimate the industry, but then a subsequent severe recession, change in retirement age, change in seniority from a merger, all these things, thankfully, were in the future because I decided there and then I needed to do something else. I needed to start some kind of a business, get some sort of security blanket. And I spent a lot of time looking at a lot of industries, and the last thing I looked at is where my talents lay, and that was because of my experience at Smith Barney. It was the one thing I didn't ever want to do again. But a good friend counseled me and talked to me, and we chatted about different business opportunities. And he essentially said, I don't know why you wouldn't start your own wealth management practice. You don't need to do it by the textbook. You don't need to do it the way Smith Barney did it. You can start your own firm on your own rules. And, let's face it, if things don't work as planned, one day you'll be flying again. Well, with that safety net in mind, I did decide to do that. I decided I would start a business, adopting a consultative approach, working with a team of experts to help my clients not only protect their wealth, but mitigate their taxes, take care of their heirs, protect their assets from being unjustly taken, and maximize the impact of charitable giving if that's important to them. I decided I wanted a firm that was predicated on the crazy notion of by taking care of my clients at an extreme level of service and fiduciary interest for the clients, that they would be my marketing program, my sole source of growth. It was a great success. 10 years plus later, it's been successful beyond my imagination. I'm very fortunate because today I can count among my clientele some of my best friends. You can't do what we do with the intensity we do it without having very deep connections with the people that we work with, and it's been a wonderful experience. This business is really important to me, and I'm going to be, I'm not a touchy-feely guy, but I will say this business is important because it's important to me not only what we've done, but what we will continue to do to add value to our clients' lives. And so this is where we are today, Efficient Wealth Management. Here based in the Woodlands, a boutique wealth management firm. We're very proud to be presenting this webinar this morning. As we all know, the airline industry has not been good for pilot pensions. There's been a lot of pain. The industry has been through consolidations, it's been through bankruptcies. Many airlines have become fewer airlines. There's been frozen and terminated pension plans. United Legacy terminated, United Legacy Continental frozen. Pilots today more than ever are responsible for their financial security. But in addition to that responsibility, they are now faced, in addition to responsibility, to complexity and uncertainty. We have acronyms that we don't even know what they mean anymore. There's a VBAN, a RBA, RHA, a B plan, a health savings account. We have still industry stability. We don't know what the future has to offer. When we talk about United Airlines and we see the Wall Street Journal put full-page spreads on how badly the airline is missing its metrics and apparently being mismanaged, naturally the pilots are a little concerned about their future. So the first thing that we get when we talk about the future of the United Airlines, and I'm going to preface everything I say with it's not as bad as it looks from the inside. Every single company has insiders that see things. They see the underbelly. United Airlines is dealing with a lot of struggles, a lot of operational issues, not a very charismatic leader. On the other hand, what's often forgotten is there's only three big airlines left, plus a fourth domestic large airline. You got United, American, Delta, and Southwest. They've cut the country up into such large airlines that they have oligopoly positions that enable these companies to make a lot of mistakes before they're in the kind of trouble they used to be in. Having said that, the first question that comes to people's mind when they're nervous is, does the lump sum pension payout always make sense? The reflex, of course, is I want my money. What are the options? The A plan options are to take an annuity, take the lump sum, or there's actually an advanced strategy that we'll discuss a little bit later. We'll first talk about the annuity. The annuity is relatively safe, and the reason it's safe is it's guaranteed by the PBGC to approximately $50,000 a year. The number actually is a moving target each year, and that moving target increases with the age you retire at and inflation over time. The annuity itself is not adjusted for inflation, just the start point. And this is kind of significant because if inflation is set to 3%, a 20-year window, your annuity will be 1/2 of what it was when you started. 20 years now is a lot more common scenario than it was 20 years ago. 20 years ago, you were retired and you were lucky to live another 5 years. Today, it's becoming the norm to live to your mid to late 80s. So one of the issues with the annuity is, will it keep up with inflation? If you're going to take the annuity, I will say this, it beats any commercial annuity. Any annuity that you buy out there for structural reasons that I won't get into in this webinar, but I can discuss, you would always get more from the airline annuity than if you took the lump sum and bought a commercial annuity. Also, another advantage of the annuity, it is, unlike the lump sum, it is a known quantity. You know how much to expect. You know that if you make it to 65, up to $50,000 a year will be protected. In fact, when we put together our quantitative reports for clients who are more than a year away from retirement, we only use the annuity for planning. That doesn't mean we're going to recommend they use the annuity or insist, but we know what the annuity will be. We're very confident in the annuity. We're not confident in the lump sum. So there is a key advantage to the annuity. There is less room for error when you take it, but there's also a key disadvantage. And the key disadvantage is there's no estate. When the annuity's gone, it's gone. And of course, when you die, you lose the annuity. So your lump sum, we talked about what it is and about the concern of it. How safe is the lump sum? The lump sum deals with a number of risks. The first is the bond-like interest rate sensitivity that it has. The lump sum is susceptible to interest rate changes. This year, the lump sum segment rates for January through June were higher than the rates being used from July through December, which means, if you've been paying attention, the lump sums actually bumped up slightly in this most recent cycle, July the 1st. That's pretty cool for people retiring right now, but it is important to understand the mechanism. The mechanism is very much sensitivity to interest rates. When interest rates go up, you will lose value in your lump sum. When that goes down, you will increase. And the reason is a lump sum is not an account. Your promise is an annuity. Your lump sum is the present value of that annuity. Or to put it another way, your lump sum is about what it should cost to buy the equivalent annuity. When interest rates are high, it costs less because those interest rates are figured in to the future value, the future ability to make payments. This is kind of interesting because the lump sum presents a challenge over the annuity. One of the big challenges and promises of the lump sum is we can design a disbursement policy that does protect you against inflation. Remember I said the annuity itself, let's say you get $10,000 a month in real money today. In real purchasing power in 20 years at 3% inflation, you only have $5,000. With the lump sum, you can generate an income that is inflation protected, but the reality check is to invest for inflation protection, you need growth, which means you need a reduced annuity payment. You need a reduced cash flow. And a lot of people don't get that. They're not mentally prepared for that. When we deal with our clients, we put together disbursement policies. It's something we try to explain for them. How safe is the lump sum? This is a great question. The lump sum is very much a function of the funding of the pension plan. Pension Benefit Guaranty Corp only guarantees the annuity. They specifically state that if funding drops below a certain level, the employers are not allowed to pay out lump sums. There's a certain amount of confusion in the system right now because of what was known informally as the Continental Exemption to the Pension Protection Act of 2006. Built deep into that law was a sole paragraph that in essence said Texas-based transportation companies, basically Continental American at the time, were exempt from the minimum funding requirements from the point of view of paying out lump sums. And it was a political patsy at the time to get it through Congress. It had been asked for by the Texas delegation, probably with a substantial amount of leaning on from Continental and American. The issue, though, is does that apply now? Because Continental Airlines, it's a memory. It doesn't exist anymore. United Airlines is a Chicago-based, Illinois-based airline. Same thing with American. For different reasons, it no longer applies. American's lump sum has been terminated. The pension plan actually wasn't terminated. It was frozen, but the lump sums were terminated. So really, that exemption doesn't apply to anyone. And the question is, the reality is at any point in the future, that funding level gets low enough, they'll quit paying the lump sum. Now, some people go into a panic mode and retire early as a result. I don't recommend that. Unless you're within 6 months and it's a significant impact, what you lose in income doesn't justify giving up a job to protect a lump sum, especially if there are other assets and especially given that there's an annuity. Again, what we would do with our clients is we would sit down and develop a disbursement policy that somewhat protects those other assets in the early years so that they can replace the annuity in later years as inflation chews away at it. So what do you do with the lump sum? There's a couple of things you would do with the lump sum. First and foremost, you roll it over to a 401k or a rollover IRA. Either way, it needs to go to an ERISA account. This is automatic if you send it to a 401k. It's not automatic when you send it to an IRA. We have what's called non-rollover IRAs, traditional IRAs, and rollover IRAs. Again, it's a small thing, but it's significant. And the reason it's significant is asset protection. One of our roles when we talk about what we do for clients, protecting their wealth is one of them, protecting their assets from being unjustly taken is another. One of the things you want is free protection. ERISA protection is free protection. Should, God forbid, there be a medical catastrophe or something else that forced you into a bankruptcy environment, traditional IRAs are only protected up to the first $1 million in value. Some states overrule that. Overrule is not the right word. Some states have their own laws that go beyond $1 million. Texas is one of them, but not all states. And if you've moved out of Texas when this should occur, you've just lost your ERISA protection if you put the money into an IRA that you already owned that had other assets, with the caveat as long as it accepted a rollover IRA. To forestall any mistakes, we just say open up a brand new rollover IRA, send the money along with the 401k to the rollover IRA. There are those that would argue keep the money in the 401k. It's a good argument, actually. Should you take it in an IRA or 401k? If you're working with us as a client, it almost doesn't make any difference because the PCRA and the Schwab rollover IRA look, act, smell, and even cost just about exactly the same. The rollover IRA will give you slightly more investment options. The 401k can be slightly more cumbersome. So in this environment, I say rollover IRA. Some environments, that's not true. If the rollover IRA investment options are not as good, or if at a different company that doesn't have the PCRA or any other factors, then maybe you should stay at the 401k. But at United, the rollover IRA makes most sense. Why would you take the lump sum? Well, the advantage is twofold: control and estate. It's a big deal to a lot of people. They want to take care of their heirs. They want something left over at the end. And of course, the lump sum enables that if managed appropriately. The second thing, people like control. Control, of course, is a double-edged sword. You know, when you have control and the ability to mess it up. The disadvantages, of course, related to control are complexity and risk. Complexity, it's not easy. Pilots are smart. Some pilots have the interest, the aptitude, and the time to go out and break the code and do it themselves. But it is complex. The mistakes that can be made, we just talked about it. Just rolling something to the wrong kind of IRA eliminates risk protection. Disbursement policy, pulling out too much in the early years, can destroy your portfolio's ability to manage a negative market environment 3, 5, 7 years down the road. So you have also market risk, you have interest rate risk, you have political risk, and you have advisor risk. And the unspoken truth that I'm going to put on the table is if you're not one of our clients, you have no idea if we walk the talk. That's why, be it us or someone else, someone who's retiring really at least a year or more before they retire should start establishing a relationship if they're not planning to go it alone. And that gives them time to determine, have I made a mistake? Do I need to reshop for new professional advice without things getting devastating for them? Now, if you remember, I talked about taking a lump sum, taking an annuity. There are some advanced strategies, and I'm going to breeze through this. So if it doesn't make sense, I would say let's talk about it later if you want more detail later. But some of this stuff will cause some people's eyes to glaze over. So I don't want to lose everyone halfway through the webinar. But one of the biggest advantage is strategies available that's not known is you can retire but not start or claim your pension. The minute you do that, your annuity starts to grow. The lump sum also grows, but it grows by less than the annuity. And this is something that's very age sensitive. So someone who's taking an early retirement can really, truly maximize this strategy. The value of the lump sum growth once you hit about 65, 66 actually starts to peter off. And it's because the lump sum is not just a function of the size of the annuity, but how many years left you've got to enjoy that annuity. And as you get past 65, you're making larger and larger slices out of your remaining life expectancy. So you take larger and larger slices out of your lump sum. But for those between 60 and 65, this is a very powerful strategy. It's a great strategy if you're willing to defer the annuity and or retire early. More powerful if you're returning early. You do, however, need to have resources to spend down in the interim. So how does it work? Remember I said at the beginning, one of the options available is to present a risk-free, zero-cost strategy that you can adopt and will turn your annuity in essence into a partly inflation adjusted annuity. It's a little bit complex, and there is a caveat. At the end of this process, there's nothing for your heirs. But this is an example of 65 to 70. I probably should do 60 to 65 in future. But at 65, you retire and you take the airline annuity for $4,000 a month. You take Social Security at $3,500 a month. That's your default. If you're going to take the annuity, that leaves you with $7,500 a month. The alternate strategy is retire at 65 and defer the annuity to 70, defer Social Security to 70. Now you're getting $10,000 a month, and the Social Security portion of that annuity is adjustable for inflation. So how do you fund that 65 to 70? And the secret is you're going to need some money. You're going to need approximately $600,000 because you're going to have to go out, take $120,000 for the first year's income, put it in a cash bucket or some other type account. And then the remaining money, you're going to want to buy 4 Treasury inflation protected securities, one for each year, and you're going to ladder them. So you're going to have one that matures in a year, one in 2 years, one in 3 years, one in 4 years, and one in 5 years. So those, 4 years. Those 4 tips, you can buy through Schwab, you can buy them through the Treasury. They're guaranteed. They're backed by the full faith and credit of the government, and they will mature at what you paid for them plus the VAT plus any inflation. So if inflation's at 3%, you buy 100,000. At the end of the year, you'll get back 103,000. You won't make any real wealth, but it will be risk-free after inflation. And that's how you generate that income. But why would you do that? If there's a risk-free zero-cost strategy, why would you invest a lump sum? Why would you invest at all? And there's a number of good reasons. One, you may not have enough money to even implement the strategy. It's going to cost a lot to do this. Two, you have essentially traded absolute safety for growth in an estate. I would make the case if you have no choice but to take absolute safety, you're probably in a position where you have to take the annuity immediately. There are hybrid alternatives that we can introduce you to if you have to take the annuity immediately to get you through for the first 5 years so you can continue to defer Social Security to 70. But you're still looking at nothing at the end. As I said, there are hybrid solutions, and we're actually a big fan of the deferring Social Security and drawing down assets more aggressively in the early years, because that's a safe plan if you have deferred your Social Security. And then, of course, there's the last option, and that is, what about insurance annuities and the guaranteed minimum withdrawal benefit? Now, this is a very popular program. You see this advertised. There's guys having seminars all the time. Come in, we'll give you a free bottle of wine, we'll give you a free dinner. We've got a program for you. I'm going to describe how these things are constructed, and the more you understand how they're built, the more you're going to understand why these guys can afford to buy so many dinners. Essentially, these are insurance variable annuities that are built with a guaranteed minimum withdrawal benefit. They're very popular among commissioned salespeople. And what they offer is market upside with a guaranteed return of principal. Now, if I just say that, if I say nothing more than I've got a product that guarantees you the return of your principal and enables you to enjoy upside of the market, you can understand how that's a pretty attractive offer. But where does this come from? How can they do such a thing? I mean, do they have some secret formula? Well, the truth is two things are going on. One, yes, you get market upside, which you don't get at all. There's going to be an insurance charge. There's going to be the expense ratio of the underlying funds, and they're not going to be Vanguard index funds. And there's going to be other charges and fees. All of this results in for example, $1 million annuity paying that financial salesperson $50,000 in commissions. That $50,000 came out of your pocket. You just don't, I mean, it's self-evident if you think about it. You're back 50 grand on day one. The insurance company is pretty much going to guarantee you that if the market's up 20%, you're not going to get that 20%. Your charges most years are going to mean you essentially break even. Some years you will enjoy a little bit of upside. What about the guaranteed return of principal? Well, first and foremost, the product requires you to be locked in for 7 to 10 years. There's almost no 7 to 10 year period in history. I say almost. If you data mine carefully at the crash in 1929, certain other events, when the market just didn't come back completely in 7 years. There is no period of 7 to 10 years in history where rebalancing a balanced portfolio, you didn't recover 100% 7 to 10 years. So in other words, the promise isn't really worth the paper it's written on, but what you're paying for that promise in terms of future returns is huge. And you might ask, I don't care, but you do care, because now we have the same problem we have with the annuity. If you want that kind of a guarantee, you might as well take the annuity. And the reason is you need growth. You need growth so you can increase your draw in retirement. So here's the problem, huge cost. The investment options tend to be pretty poor. Usually if it's a prudential annuity, for example, and I'm not picking on it, most of your options are prudential mutual funds or mutual fund companies aligned with prudential funds that are going to have higher charges. And there's a final reason you don't want to deal with this, and that's what's called unsystematic risk. Unsystematic risk is risk that can be diversified away. And it's very poorly understood, but it's the biggest problem with these products. The holdings are diversified. As a financial salesperson or annuity salesperson, well, wait a minute. We're in all these different mutual funds. And they're right. The underlying investments are diversified, but the guarantee is backed by one company. And that company is the insurer. And if the insurer fails, the guarantee is not backed by any state agency. It is not like the guarantee that exists for term life insurance. If an insurer fails, there's a pool that acts as a backdrop for those guarantees. So there is unsystematic risk. It is risk of insurer failure. And when is an insurer most likely to fail? We've seen it happen. We saw it happen in 2008. We saw huge bailouts of AIG and some other insurers, and we saw something else, and that's bailout fatigue. If the insurer is not going to cause a systemic risk to the economy, then the government's not likely to bail it out. It's not politically acceptable anymore. So that risk exists. And of course, if the strategy that's often been taken of an aggressive portfolio with a GMWB, with a guaranteed benefit, is deployed, the market takes a dump, the insurers find themselves in trouble. Not only have you taken a very large real hit, especially after expenses and fees, but you're walking away without a guarantee. So without getting into that anymore, the one thing that we have never ever recommended our clients is an insurance variable annuity. We just didn't think they're good products. We don't think they meet any fiduciary standard. In fact, the last reason I wouldn't want it is the deferral. They talk about the deferral. Wait a minute, if the money's in an IRA, it's already tax deferred. It doesn't need the deferral that comes from an annuity. So let's talk about United benefit plans. We're going to segue into this. United benefit plans are really complex, but also, in my opinion, really good. The first plan is the VEBA, the RHA, Retirement Healthcare Account. It's a tax-advantaged trust which provides employee benefits. It is designed to pay for your healthcare in retirement. Now, you can't contribute to it directly. You do contribute indirectly or through the company. The company withheld $1 an hour over Delta, so they could put $1 an hour on your behalf into the VEBA. Also, you can manage it slightly indirectly. If you make between $210,000 and $260,000, you can actually tweak how much goes into the VEBA by how much you put into the 401k. And the reason for that, I'm going to keep this simple, is there's something called a 415C limit. And in the 415C limit, you can't put more than X dollars, about $56.5 right now, into the 401k and the B plan. When you hit that limit, money goes into the B plan, it spills over to the VEBA. You can stall when you hit that limit by putting less money in the 401k, or you can accelerate when you hit that limit by putting more money in the 401k. The sooner you hit the limit, the more money goes into the VEBA. Only from the B plan, and there are caveats, but your contributions into the 401k cannot spill into the VEBA. Company contributions can. When does the company contribute? Usually it's vacation, things like that. So there's a little flexibility in there. Our take on the VEBA is if you're under 50, don't be in a hurry to max it out. There is a little bit of unsystematic risk, in the VEBA. It's not a great deal of risk. I don't want to get into the detail. I'm available to talk about it later. But we've advised clients below 50 not to max out the VEBA. Just put in the minimum. There's not a lot of control anyway. If you're over 50, you're going to have plenty of opportunity to take out the money before the kind of risk that I'm considering would be an issue. And really, what is the risk? It's not the risk that the airline goes bankrupt, because the money is going into something that's similar to what's called a rabbi trust. The risk is that the VEBA takes over liabilities. It could be retiring medical liabilities or stuff. That can be allowed to happen. Not going to happen before the next contract for a fact, but it is possible. And so for younger people, we're not a big fan of exposing them unnecessarily to that risk. Health savings account. The best way to think of a health savings account, and this is brand new, this is the first year they had it, think of it as a hybrid traditional and Roth IRA. It's very powerful. A company puts $1,500 into it. It's powerful because it gives you the best of a traditional and a Roth. It's the only thing out there that gives you the best of both worlds. And here's why. You put money, when you use a health savings account, you're using a high deductible health insurance program. Now I'm going to caveat, that's the problem with all of this. If you have chronic, high, ongoing medical expenses, you may not want to do this. But if your health expenses in general tend to be modest, then I would recommend the health savings account. Put in as much as you can into the account. Now, when you get claims, you can take the money out of the account to pay the claims, but you may decide you prefer to leave them in there. And here's why. That money in that account will grow over time. It can be used in retirement as a regular IRA, and just like a regular IRA, you take the money out and you pay tax. However, it can also be used in retirement for medical expenses, long-term care expenses, long-term disability. Well, actually, that's before retirement. But it can be used for all those expenses. And when it is, like the VEBA, the money comes out tax-free. That's very powerful. And unlike the VEBA you don't get to keep. The VEBA can pay for your retirement expenses. And of course, you'd use the VEBA before you'd use the health savings account in retirement. The VEBA can be used for your direct descendants expenses, young children, and your spouse, children below, I think it's 26. Health savings account, that money goes into your estate if you don't use it. Very powerful account, best of both worlds. Can use medical, can be used for retirement expenses. Also, United Airlines has come up with a new retiring medical plan in this latest contract, and it's a great program. I've had a lot of phone calls with people on this. It's got a lot of issues, and most of the issues is this concept of it being secondary to Medicare. If you have the UAL retiring medical plan, and you have Medicare, and you should have Medicare at 65, it's the second payee. A lot of people think, okay, that means it's not the same as Medigap. Well, they're right. It's not the same as Medigap. And the reason is a little technical. I don't want to get into it. It's better than Medigap. With Medigap, if for some reason Medicare is not paying it, and it's not everything that they think Medicare will pay is carved out of a Medigap policy. So if Medicare chooses not to pay a bill, Medigap won't pay it if they should have. With this program, if Medicare for some reason that's not expected chooses not to pay a bill, then this plan will pay it regardless. So it's a slightly better coverage than a Medigap policy, but it's a shade. What I hear a lot though is a lot of people going, well, it's second payers, you still need a Medigap. No, you don't. You don't need it, and you must have it if you want your spouse who's pre-65 to be covered by the United Retiring Medical Plan. You can't elect not to have it and then hope to cover your spouse. So we talked about supplement Medigap. 401k, we know if you're over 50, you can put up to $23,000 in 2014. And I started talking about the 401k because now we get into the new PRAP. And my little thing here is the ABCs of the new PRAP. What is the Pilot Retirement Account Plan? The Pilot Retirement Account Plan is a new plan that combines the 401k with the B plan and the new C plan into one account. Really much more complicated than it needs to be. I'm going to try to really simplify it. First, United Airlines is the record keeper for this thing. It is not the custodian. We've been monitoring the implementation of the new PRAP. It's in place. We're working with the clients closely, watching their accounts closely. Now that it's in place, if you're a client, we're going to make sure your investment plan is coordinated with the most tax-efficient use of the PRAP while minimizing fees. And how would we do that? There's a number of accounts. We're trying to consolidate assets into as few as possible for simplicity. We won't consolidate if that runs up the transaction costs that Schwab would incur. But here's a little diagram of the PRAP. First we've got, and this is why I call it the ABCs. First we've got the A plan. The A plan, of course, is only for the Continental Legacy pilots. United Airline contributions that fund that, that's sort of on the side. The A plan actually explains why we have a C plan. Originally, when the PRAP was designed, it was designed and set up to be one account, and it was really quite elegant. The idea was to get rid of the 401k, get rid of the B plan, get rid of the C plan, have one PRAP that you can put 401k contributions in, and the company can put their 16% in. Simple, elegant. For various political reasons, that did not happen. The Legacy United guys naturally and justifiably are very upset about the total loss of their A plan. And so as sort of a symbolic account, when they lost the A plan, it wasn't symbolic at the time. They were given a C plan in addition to a B plan. And I won't talk about what went into it. We have a few United Legacy clients. It was an insurance product. It was just something to help replace the lost value of the pension. That C plan today is really identical to the B plan. It's just an empty bucket, another account, looks the same, acts, smells the same as the B plan. Instead of 16% going into the B plan, now what they're doing is they've split that 16%, put 9 in the B plan, 7 in the C. There are ways to actually move money from the C plan bucket to the B. We try to do that if we can. It's too new to see how well that's going to work for us, but we are trying to keep it simple. I guess I'm not looking at this from a political perspective. I think it's the most ridiculous thing I've ever heard of. I probably shouldn't say that. It's a sad thing we didn't get rid of the B and the C plan, but we got it. There are those who feel the C plan will add negotiating leverage down the road. I hope it does. I hope they're right. Because if it doesn't, all it's done is add confusion, complexity, and costs. Fortunately, Schwab has decided and elected to absorb the costs so that the pilots aren't being hit with slightly higher fees, as reasonably they should be, because basically they've generated more costs for Schwab by creating this structure. But be that as it may, this is how the PRAP looks. And if this doesn't make sense, you have any questions, we're going to have a Q&A at the end, and also feel free to call us after this. We can talk about it some more. So let's talk about defined contribution plans in general. You know, the PRAP, the B plan, the C plan, the 401k, they're all in essence the same thing. They're defined contribution plans. And this is the wave of the future. You know, there's a lot of people who want a new A plan. I'm going to take a political stand here. I don't mean right, left political. That's a big mistake. Every single company that's ever had an A plan has had two things happen. One, it's caused them financial distress. And two, the plan's had distress. It just doesn't make sense to resurrect the A plan. I don't know why you'd want to do it. This is the wave of the future. It does create challenges. So we need to, what are the challenges? How do we distribute to disperse through retirement? What's the most durable strategy for disbursements with portfolio risk? And the way we handle this is through generating what's called disbursement strategies, or I call it a disbursement policy. Now, we've already discussed a risk-free zero-cost plan that was inflation adjusted and left you with nothing at the end. But what if you're unwilling to follow that strategy? How do you manage the various and varying cash flows? And what we've put together is something called advanced cash management. I'm going to try to breeze through this. Our clients have seen advanced cash management. What we like to do is set up a scaffolding or an infrastructure of accounts for the clients before they're retired, ideally. And we try to separate the long-term investments from what we call a cash bucket. Long-term investments are money that we can tolerate volatility in. You get growth for absorbing risk. There's no secret sauce here. You have to have a way to tolerate that volatility that goes with it. So we do it by separating long-term investments from the cash bucket. Before the client's retired, if they go full bore with advanced cash management, we have their employer income be sent through the cash bucket and through savings to the long-term investments, and we convert that variable income, because people's flying varies, using the cash bucket into a fixed income so we can find out what it is they need to live on in retirement and get them used to living on a fixed income. Once the client's retired, all we have to do now with the same scaffolding is change the direction of the cash flows, add Social Security and or pension income or military retirement into the cash bucket, supplement that cash bucket with what we call homemade dividends. I've got a great video on how we make homemade dividends on the website. It's a much better strategy than biasing a portfolio to high dividend stocks. But we've got a great strategy for that. Keep that cash bucket full, present the personal checking account with a constant cash income that ideally hasn't changed since pre-retirement. Now I'd like to introduce you to Ashley. Ashley's been with us now for almost a year. She's very talented, very excited to have her on board. Ashley, why don't you introduce yourself, tell us a little bit about yourself, and tell us about some of the research and findings that we've had based on our studies with pilot interviews.
Great. Thank you, Paul. Thanks for having me on the webinar today. So like Paul was saying, I came on board about a year ago, and prior to that, I was working for an independent broker-dealer for about 3 years. And then last year, I acquired my CFP certification, and at that time, I started looking for a firm like Efficient Wealth Management, and that's how I got here. So on the next slide here, you will see the key concerns identified by our research. So last year, we put out a white paper titled Flight Plan for Retirement. And while compiling research for this white paper, we conducted a survey across the top airline pilots to identify what the top concerns were. And you can see here in the chart, the first item was protecting their wealth. Of course, the pilots want to make sure that all the wealth that they have saved that is going to be protected and it's going to be there for them whenever they need it. And secondly, was planning for retirement. They want to make sure that they don't outlive their resources. And then third, maintaining their current lifestyle. So in conjunction with not outliving their resources, they also want to maintain the same type of lifestyle that they have now. And of course, taking care of their heirs. If something unfortunate was to happen to them, the pilots want to make sure that their wealth is transferred to their heirs in the manner that they prefer. And then mitigating income taxes. And then lastly, having enough health care coverage during retirement. So that covers the top 6 concerns that we identified during our research for the Flight Plan for Retirement white paper. I'll give it back to you, Paul. Thank you.
Thank you, Ashley. I got this little clicker. Sometimes it doesn't work as well as it should. Here we go. So how do we solve this problem? For our clients, we have adopted a consultative wealth management process that's really designed to attend to all of those concerns. And we actually designed the process and the wealth management model based on the key concerns of our constituents. Our consultative wealth management process starts with a discovery meeting, which is an opportunity to sit down and get to know if we're even a good fit. Because if we're not a good fit, we'd rather just introduce our new client to another advisor that they'd be better suited to. And maybe the advisor they've got is doing a perfectly good job. After that discovery meeting, we'll put together an investment plan, build an investment policy statement, and present it at the investment plan meeting. Even if you wanted to start as a client at that point, we would ask that you wait. We want people to be sure before they continue. After about a week, we would conduct a mutual commitment meeting, and that meeting is where we decide to continue. After the mutual commitment meeting, 2 things happen. 1, paperwork. Schwab goes out, cuts a tree down, slices it in little pieces, mails it out to the client. It's a lot of junk. Some of the stuff's good, a lot of it's junk. At the same time, we start working on our advanced plan. And this is really where we separate wealth management, investment consulting from advanced planning. We're going to talk about that a little more in a second. We'll bring together a team of experts. Our Verizon team is the way I like to think of it. And they will work with us to put together advanced planning recommendations. Now, while that process is going on, we have a 45-day follow-up meeting, which is actually, in my opinion, one of the most valuable meetings because that's when there's a lot of aha moments where we can go back and ask you more questions, where the client can come ask us questions. We take all of those meetings and the expert team build the wealth management plan and present that at the regular progress meeting. So what is wealth management? Simply put, wealth management is investment consulting plus advanced planning plus expert relationship management. And what I'd like to do is present a little video that I put together that better describes it. It's just about 3 minutes. Don and Laura have had plenty of success both in their careers and their marriage. But like 4 out of 5 successful couples, they're not sure that they have the right financial advisor to help them meet their family's long-term needs and goals. This isn't exactly surprising when you look at the numbers. With over 460,000 financial advisors to choose from in the U.S., you need a system to help you spot the best from the rest. So Don and Laura did some digging. It turns out, in more than 1,400 successful couples studied, most reported 5 major challenges and concerns when it came to managing their finances, which we will explain to you in just a moment. With that in mind, it only makes sense that the most successful and capable financial advisors use a wealth management formula that incorporates 3 key components to specifically address and solve the most pressing financial management challenges faced by people like Don and Laura. Investment consulting. The first component, investment consulting, deals with the number one concern of successful individuals and couples, which is to always make smart decisions about their finances, using investment strategies to support the quality of life that's important to them. While 100% of financial advisors claim to do this, only a few do it well. The next part of the formula addresses advanced planning, and unfortunately, only 6% of financial advisors proactively do it. It takes care of the other 4 top financial challenges. Here's what it looks like. Wealth enhancement. The second biggest concern of successful individuals and couples involves their desire to mitigate income taxes. Top financial advisors respond to that concern by developing strategies to protect your income from being excessively taxed, allowing you to keep more of your hard-earned money. Wealth transfer. Successful people are concerned not only with their own wealth, but also the wealth of their children, grandchildren, and so on down the line. Advanced planning gives you the peace of mind in knowing your own wealth will take care of your heirs as well. Wealth protection. The fourth major financial concern reported by successful individuals and couples involves protecting the wealth they've worked so hard to grow. This makes it critical to put barriers in place that prevent your wealth from being unjustly taken from you. Most successful people are contributors and want to make a difference in the world. So it only makes sense that the 5th biggest financial concern is the ability to leverage their wealth in order to magnify that impact, using it to benefit society through charitable planning. After lots of careful thought, they were convinced that advanced planning was the key to the financial future they envisioned. But there was another piece of the wealth management puzzle that they knew was critical as well: relationship management. Simply put, top financial advisors have a clear and compelling process to deal with each of the 5 financial concerns we discussed. This includes not only their relationship with you, the client, but also the other professionals related to your wealth management, like accountants, attorneys, and life insurance specialists, with whom they can work in a coordinated fashion to help you meet all of your big picture financial goals. At the end of the day, Don and Laura see themselves as co-CEOs of their family. Likewise, they see their new financial advisor as their own personal CFO, helping them to achieve all that's important to them and their family throughout the course of their lives. To receive a complimentary second opinion in your finances and learn about the impact wealth management can have for you and your family, please contact us at 281-528-1200 or efficientwealthmanagement.com, the email address below. Great. So that's our little description of what investment consulting versus wealth management is. So our promise at the beginning of this webinar was we'd have some stuff if you've made it through. The first thing we've got is Flight Plan for Retirement. If you haven't already received this, we're going to go ahead and send that out to anybody who requests it. Second is we're going to keep track of whoever's been there. We've got a first edition copy of our new book coming out, Flight Plan for Wealth. Very excited about this book. It was essentially going to be an ebook to start with. It has now morphed into something substantially more valuable. We will get a first edition copy out to everybody, if that should be published within the next month or so. Also, we'd like to introduce you to the Second Opinion service. If you're not a client, we do have a free Second Opinion service. This service is valued at about $3,500 worth of our time. And what we do in the Second Opinion service is we sit down with you, do a discovery meeting, find out where you are, where it is you're trying to go, see if there's any gaps that need to be filled. And if there are, there's one of three real solutions. One, it may be that you're perfectly well taken care of. And if that's the case, we'll let you know. Two, it may be you do need help, but you're not a good fit for us. Unfortunately, because we're a boutique service, we do limit our clientele to those people we can make a meaningful impact on. And third, if it is a good fit and there is a need, then we would continue the conversation. That Second Opinion service will be made free to the first 10 attendees who schedule an appointment with us, even though it's valued at $3,500. We actually have a clip here. It's your invitation. If you click on that, it will open you up to our page on our website where you can send us your information. Or alternatively, you can call us at 281-528-SQUAWK 1200. So before I continue and wrap this up, are there any questions? And I should add, we have the chat screen here, so you can tap them in. All right, I got a question here. Is the United Airlines retiree policy the same Aetna policy I have before retiring? Yeah, it's very similar actually, and it's provided by them. The difference is the carve-out for Medicare. It's one of the things that's interesting about it is you are going to find it may be slightly more expensive than some of the other Medigap policies, and that's for two reasons. One, it's a group plan. A group is normally cheaper, but it's not normally cheaper for your age group. And the second reason is it includes the guaranteed underwriting of your spouse, who if he or she is younger than you, it's usually she, will be on the regular Continental plan. Any other questions? How do I know which accounts to take retirement funds from during retirement if I defer Social Security in the A plan? That's a good question. And you know, there's some canned answers. One canned answer is take taxable funds first. The more nuanced answer is it depends. Obviously, if you take taxable funds first, i.e. funds not in an IRA, you're not going to pay income tax on those IRA withdrawals. But the downside is you're going to have even larger IRA holdings when you hit 70 and a half. And at 70 and a half, you hit what's called required minimum distributions. A better strategy, there's actually two better strategies. One is to set those withdrawals of the IRA so that you hit about a reasonable tax limit, 15, 25%, depending on the sizes of the accounts, that will stop you getting pushed into bigger. But the optimal strategy usually is spending down taxable money and converting some of those rollover or traditional IRAs into Roth IRAs on an annual basis. And each year, what we do with our clients, we actually have a CPA liaison, Elizabeth, who works closely with the CPAs on this. We will calculate how much they should draw from taxable accounts, how much should be converted to Roths, and how much should be drawn from traditional money, so that the lifetime maximum tax benefit is attained, even if that means a little more tax in the short term. Any other questions? Let me just see if we got any other clicks here. If United goes bankrupt, is the lump sum protected? No. If United goes bankrupt, there is no lump sum. It's a really big deal here. What would the PBGC allow? It is very, very unlikely that the PBGC would terminate the pension for a number of reasons. The most important reason is it's already happened. It's the same airline, and there are laws against more than one termination in a certain amount of years. The second reason is the American Airlines precedent. With American Airlines, when it failed, the lump sum was shut down, but the pension plan was not terminated. It was just frozen. But if the company goes bankrupt, you can guarantee that the lump sum will go away. Any other questions? Is my YSA protected? You're talking about the HSA, I think. Is the HSA protected? And send another text if I'm wrong. The health savings account is not affected by United. That money is kept separately in a trustee account, just like the 401k. The HSA, one thing I didn't mention, and I'll be real brief because I'm a minute over the promised timeline. The HSA goes into a different account, different trustee, and these are relatively new. One of the downsides, and it's not a reason not to use them, but one of the downsides of the HSAs is the accounts are still a little bit limited on the options that are available and the number of people who will accept custody of those accounts. I know Schwab won't, I think Fidelity won't, most of the low-cost broker-dealers won't handle HSAs in retirement, but the money is safe. Got another one coming up here. The YSA account card. I'm assuming you're talking about some kind of reimbursement account. I don't, for whatever reason, I'm drawing a blank on what you were asking there, Hap. So let me just call you after this, and we'll make sure I'm not misunderstanding. Well, I do believe that's all the questions we got. That's it. We're a couple minutes over. I do appreciate your patience on that. I try to get it at or under 60 minutes. If you have any additional questions, you like follow through, you like the white paper or the first edition, please feel free to email us. You can email us at paul@ewealthmanagement.com. Phone number is 281-528-SQUAWK1200. Or, of course, efficientwealthmanagement.com. We've got a lot of great videos on that website. A lot of informative videos done not by myself, just by myself, but by others. I did appreciate your attendance today, and thank you so much. I'm going to go ahead and shut this down.